We have the sound and vision operating properly, so it's about time to begin. So, if you do have any questions, please feel free to get those questions in, and I'm more than happy to try to answer them for you. Okay, so we had a great session last time. Let's keep the momentum going. Just great stuff by everybody there, and I appreciate it. Okay, okay, I'm just checking my schedule here. Don't mind me, but I know I'm going to be with you again. This is not the last time you'll be seeing me. You're going to be seeing a little bit more of me. Today's the 22nd. Tomorrow I'll be back on the 23rd. And I'll be with you again on the 25th of this week. So today, Tuesday, and Thursday, 2 sessions each day. So please do join us for those sessions, and I'll look forward to seeing you then. Okay, let's get ready to rumble here. I've got the S&P 500 up on the chart, including the futures. And you can see the futures. We're red today on the futures. A little bit of red. All right, some big buyouts out there. This company, this pharmaceutical company buys MVDN, MDVN. Several big buyouts. This is a $14 billion buyout. Right, they're getting bought out. And they're getting bought out by Pfizer, which will probably drop a little bit on that news, but that's okay. All right, so lots of stuff happening out there, like mergers and acquisitions. Overall, stocks have been going mostly sideways here in the U.S. recently. There's really no alternative to buying stocks, which is why they're doing so well. Bond yields are tiny, minuscule, really. And they don't really present much of an option as far as where you're going to put your money. You can make more on a stock dividend than you can on a bond. We have many bonds with negative yields, of course, and that's just a sign of the times, I suppose. Okay, let's take a look, and we'll get to some questions here. Hello, Ed, says Camilo. Good to see you, Camilo. I'm new with you. Do you trade using fundamentals also? Yeah, definitely yes. In other words, short-term trading has very little to do with fundamentals, right? But long-term trading has a great deal to do with fundamentals. And this chart is a pretty good example. This is dollar Canada. And whenever we saw a huge trend in oil and then a reversal in that trend, and you can see it on the dollar Canada chart here. When USD CAD is rising, what's happening to oil? Oil was rising, and this is Canadian dollar is actually falling on this chart. I'm sorry, dollar CAD is rising as oil is falling. Dollar CAD is falling as oil is rising. And CAD is the second member of this pair. So a really easy way to express this relationship is if I isolate Canadian dollar. This is just purely Canadian dollar. This is the ETF. The symbol is FXC. An ETF is an exchange-traded fund. So FXC trades just like a stock. Okay? And compare that to, let's compare FXC to the price of oil and see how that shapes up. Okay, you might see some similarity here. It's not exactly, they're not exactly the same, but there's real similarity here. As Canadian dollar is trending stronger at the beginning of 2016, the price of oil is gaining. And even now, both of these are rising. Canadian dollar is rising up here. Price of oil is rising down here. And what this is showing us is that the technical aspects of this chart are driven by fundamentals. So longer term, this tends to be the case. Longer term, fundamentals can drive technicals. Shorter term, fundamentals can be somewhat irrelevant. The shorter your time frame, the less relevant fundamentals become. But I definitely use fundamentals because what this chart should demonstrate to us is that technicals and fundamentals are really two different sides of the same coin, right? And if there is a major technical move on a chart over a long period of time, there's a very good chance that it's being driven by some fundamental event or condition. Okay? So technicals and fundamentals are two different sides of the same coin, is the way I like to put it. By the way, probably the most interesting part of this chart occurs at the beginning of May. Now these two, Canadian dollar on top, oil on the bottom, they move mostly in lockstep. But there's one point here where they diverge. The price of oil drops sharply in early May. I'm sorry, the Canadian dollar drops sharply in early May. You see it here. Canadian dollar drops sharply. Oil does not. So what happened there? Something changed. Right? In other words, it was something else that was fundamental that hit the Canadian dollar, and that was a large fire. There was a large fire, and a large town had to be evacuated basically for a month. So imagine if you take a large town in any country and evacuate it for a month, and no business transpires there for a month. That's going to hurt that country's GDP, and I think you're seeing it right there in Canadian dollar. Canadian dollar takes a hit on the Fort McMurray fire, even though it has nothing really to do with the price of oil, and the price of oil just keeps chugging along, right? But what that demonstrates is oil is not the only fundamental that drives Canadian dollar. It might be the most important one, but there are other things, right? It's not as if Canadian dollar and oil simply have the same chart. There are other factors as well, right? And that's an example of one. A large natural disaster caused these two to diverge, at least temporarily. Okay, so good question. And I'm a big believer that, we do pay attention to both technical and fundamental in this room. We use everything we can, because it's a tough game, and you try to win the game. Now, looking at this chart, it looks like we've actually got a gap. We actually got a Sunday night gap here, considerably sized, right? We close on Friday at 128.61, and we open on Sunday night at 128.90, so it's about a 30 pip gap. Pretty significant gap. And if dollar CAD is gapping up, that means US dollar is stronger, Canadian dollar is weaker. So if Canadian dollar is weaker, there's a very good chance that oil is down. And there you see the big red candle for oil. Oil's had a heck of a run recently, so has Canadian dollar, but they're both on the back foot today. Maybe that creates a buying opportunity for oil, and maybe it creates a selling opportunity for dollar Canada. Right? So the way that I often look at that is you've got this rally. Now, the one thing I want to be careful of is I got to be careful about going against this move. Do you see how the gap goes in the opposite direction of the trend? That can create short covering. The shorts are very, very happy, is it safe to say? One red candle after another. And we move all the way from 132 down to 127, a 500 pip move. And suddenly it gaps the other way. The shorts probably going to start to cover. And I think we may already have seen some of that. But you have to be careful in these situations. But the trend appears to be down in dollar CAD right now. Although it's down within a sideways. The bigger picture appears to be sideways. You really have a back and forth here between 132 and 127. That's really how this chart shapes up. So there's a couple different ways to play it. If it gets down near 127, I might be a buyer. Because there's a lot of support down there, and you look at this chart, right? 1, 2, 3, 4, 5 times we come into close contact with 127, but the market reverses every time, and so there could still be buyers looking to buy down at those levels. This is fairly recent, so we could have buyers still looking to get in the 127 area. So if it gets down to 127. The way I look at it, we have 500 pips of upside to 132, and if it breaks 127, we just get out. We just don't hold on to the trade if it goes against us. So that's the way I'm looking at this now. If it continues to rally, I might be looking to sell short because, again, the bigger picture, short term, it's trending downward, and this is a counter trend move. But within this bigger picture, it's sideways. And we've been sideways since May. Right? So 1, 2, 3 months plus, we've been stuck in a 500 pip range. Okay? Interesting. Currency, Canadian dollar right now. And, the ties to oil are very, very well demonstrated. News in oil has been a big driver here. Rumors even have been big drivers in the price of oil. So can't ignore that, right? I do think the price of oil sort of has an artificial ceiling to it because think about this. There's a tremendous amount of oil in the ground, and we know we can get it out of the ground. But at low prices, it's not worth drilling. Well, if the price of oil goes up, suddenly it becomes worth drilling, and a lot of that oil that is sitting under the surface begins to move higher. The way I would describe it is this. You have a lot of oil in the Middle East that's easy to obtain. You don't have to drill very deep, and there it is. Right? So it doesn't cost much to bring it out. You don't have to do very much to get to it. So it's very cheap to drill that, and your break-even price is very low on that oil. But a lot of the oil in the U.S. that has recently been discovered or that has been recently tapped is a little bit tougher to get to. It costs more to drill deep or drill sideways or drill through rock or to frack or, all this stuff costs money. And therefore, your break-even point is higher for a lot of the American companies. The break-even point is higher. So a lot of the American companies are not keen to drill under $50 a barrel. But if we begin to get above 50 or even above 60, then a lot of those companies are going to be very excited to start drilling again. Right? And that could, in turn, bring the price back down. So I see that it's going to be very hard for the price of oil to have a sustained rally of the type that it used to have. I don't think it's going to make it back to $100 a barrel for a long, long time. Okay? Because there is no, OPEC simply does not control it the way that they used to. Let's talk about gold for a second. When I think about gold, I think about Canadian dollar, but there are other currencies that I think of even more. This chart looks as interesting to me. I see a big rally and then some lower highs, but I also see higher lows. So we would call that a symmetrical triangle. And this is not a very reliable pattern, in my opinion. Generally, they believe this is a continuation pattern, so that if it goes up, then it's sideways, then higher. But really, whichever way it breaks is the way it tends to go. If it breaks down, it tends to go lower. If it breaks up, it tends to go higher. But the truth is, it's just not a very reliable pattern. So gold a little bit tougher to call right here. I will say this about gold. If this line breaks, especially if 1320 breaks, then gold's going to be in trouble. Right? If 1320 is right here, see this support area right here? If that support area breaks, then this thing's dropping, I think, to 1260. See, a straight line up could make a fairly quick move back down. Okay. So that's gold, and that's copper. Oh, copper, I want to show you copper. We said when you think of gold, you think of Canadian dollar, but actually the relationship between, did I say Canadian? I meant Australian dollar. Actually, the relationship between copper and the Australian dollar is stronger than the relationship of gold to the Australian dollar. And so here's copper, and here's Aussie. Right? So copper's falling, it's going to put pressure on Aussie to come lower. This is still very much in an uptrend, but we know that Australia cut interest rates recently, so this could be getting ready to reverse. And copper coming lower puts pressure on it. If I compare using ETFs once again, there's Aussie on top. Now I'm going to put gold on the bottom first, which is, gosh, what is gold? GLD. And we'll compare them side by side. But I think what you're going to notice is that the relationship, while there is clearly a relationship there, it's not as strong. I mean, here we see gold and the Aussie on top, gold on the bottom. Here they're moving in the same direction. Here we see them moving in opposite directions. You know, and so the relationship here is not as strong as it could be. So I don't really think about gold when I think of Aussie. Look at this huge difference here, you know, between Aussie and gold. When I think of Aussie, I think of copper. I'm going to replace gold with copper. And watch and see if they resemble each other more closely. I think that they do resemble each other more closely. That's Aussie on top, copper on the bottom, not gold. Why is that? I think it's because people get excited about gold and they don't get excited about copper. There's something about gold that makes people emotional, and therefore it's easier to create like a bubble, for example, in gold, because bubbles are usually driven by emotion rather than reason. But I don't think people get emotional about copper, and therefore, you know, when gold had that huge rally, 2008, 2009, 2010, copper did not, and that makes sense to me that copper did not. I mean, because people get emotional, like I said, about gold, but not about copper. Really strong relationship between Aussie and copper here. I like that relationship better. Gold is money, says Joan. I'm not denying that at all. In fact, there are those who will tell you that gold is the only money, and that everything else is just paper. So I'm not denying that gold is money. It is. What I'm saying is the relationship between Aussie and gold is not as strong as the relationship between Aussie and copper. Is gold leading Aussie? It's a good question. I don't believe so. I'll go back to gold and Aussie. I don't believe it is. And the reason is, like, there was probably a time when either Aussie would lead gold or gold would lead Aussie. But what happens over time is that people create programs. So if, let's just say, somebody recognizes a relationship between Aussie and gold. So every time gold goes up, they create a program that automatically buys Aussie. And every time Aussie goes up, they create a program that automatically buys gold. And what begins to happen is they begin to move in tandem. They begin to move together. And we see that now more so than ever. It's impossible to say that one is leading the other, because they seem to move, when they're moving together, it seems to happen at the same time. And that's the effect of technology. It used to be that there was lag time that you could take advantage of. I'm not talking about this specific relationship. I mean about all of these relationships. There was a lag time, but computer programs have made those lag times disappear. Okay, great questions. All right, let's get to some. Let's get back to some currency charts here. So, whoops, cancel that. Let's just remove gold and let's get down to business here with Euro Aussie. Euro Aussie. We talked about support and resistance trading. Euro Aussie appears to have made a nice bounce off of support. This goes back into last year. What a bounce. From about 144.30, and really if you call it 144.50 is right there. You can see how we bounced out of this area in December of last year. We come very close to this area before bouncing in March. We bounce off of 144.50 in April. We come very close before bouncing in July, and we bounce off of it in August of this year. That is a phenomenal area of support. And you can even go back farther and say July and June and July of last year, this area acted as support. That is really phenomenal. Not only did it act as support, but before it acted as support, it was, boom, resistance. Resistance and support, right? Lots of support and resistance. So, to me, if this ever should break, it becomes a phenomenal opportunity to sell short. Because there's so much activity at 144.50 in Euro Aussie. You can bet that if it comes back down there again, longs are going to be buying, right? You can bet on it. But that doesn't mean that, but if it breaks, it's going to be such a huge selling opportunity. I had my eye on this, but it just did not break. It bounced this time. If it had broken, when these break, it becomes very emotional, and that's the opportunity. In the shorter term, not only do we get a strong bounce, but we appear to be breaking above an area of resistance here. Don't be surprised if this thing takes a break here, takes a little breather. As we get closer to 150, big round number, right? And you can see it fades a little bit from 149. But both countries, fundamentally speaking, both countries are in easing mode. Aussie cut rates recently. The European Central Bank indicates that they could go deeper into negative territory when it comes to deposit rates. So they're both going in the same direction. Really, all the currencies are except the U.S. And the only reason the U.S. isn't going in the same direction as the others is because they just seem so unsure of what's going on, as the Fed is what I'm referring to here. So kind of a fascinating situation with Euro Aussie. Does have some resistance up here, might be a short, but it's really, this is the key, 144.50. That's the area that I'd be watching. What about the Aussie itself? We looked at this earlier. Very strong uptrend, but lately it may be fading. Looked like we tried to get under this trend line earlier today. That move has fizzled out for now, basically due to dollar weakness more so than Aussie strength. The dollar is a bit weaker today. Just checking the dollar really quick. Whoops. It did gap up, but then it came back down. So it's about break even today, I should say. But Aussie hanging in there. But if this trend line breaks, this could be... Now, some people, when a trend line breaks, they get all excited and they sell short. To me, that's not the catalyst. If the trend line breaks, right now you have an uptrend. Right now you have higher lows and higher highs. If this trend line breaks, it's not telling me to sell short. It's telling me that the uptrend is no longer valid. But isn't it possible to go from an uptrend into a sideways motion? It doesn't mean that we have to immediately go into a downtrend. And I think this is a big mistake that a lot of technical analysts make if they are new to the game. Whoop, there's the opening bell. If they're new to the game, they make that mistake. They think if a bullish trend line breaks, it's time to become bearish. A bullish trend line can break, and then this thing could go sideways for a while. We really have no idea. And you have to know that you don't know. But it does, if you're bullish on Aussie, though, this trend line is the line that you're watching right now. It's kind of hard to justify remaining long if this trend line breaks. But the trend line break doesn't mean you automatically sell short. Maybe it just means close the long position and stay out until it picks a direction. By the way, getting back to that gold is money comment. I mean, gold is one of the Australia, one of the top 5 suppliers of gold in the world. So Australia really just a big mine that digs for gold, copper, iron ore, and coal, and that's really their economy. So a very much dependent on commodities prices, not a very diverse economy, right? And so we keep an eye on things like copper and gold prices when we look at Aussie. So if gold breaks down, that would definitely put pressure on this. What if the trend line holds? If the trend line holds, this could be a buying opportunity for those who are bullish, right? If this could be a buying opportunity for the bulls here, because a pullback to the trend line is generally considered a bullish event. What I would do is go down to a 60-minute chart and look for an oversold reading on the 60-minute RSI. So, for example, RSI, Relative Strength Index, and you can see these little buy signals. They occur on the dips. We dip down, and there's a buy signal. Boom, it pops up 100 pips. We dip down, there's a buy signal, and not much happens. It kind of fizzles out. Goes up a little. We dip down again, and there's a buy signal, and this one could be the winner, winner, chicken dinner signal. We don't know, but that's the dip underneath the trend line there. It becomes oversold at the same time. That could be a buying opportunity. Another way to look at it is this. Short-term, 60-minute chart. There's resistance. Really, really close to resistance. I don't assume a break of resistance. What I do is if it does break above resistance, I can set up a buy under that line, because what is resistance now should become support if it's broken. Right? So this is the major trend line. This is a little resistance area on a lower time frame. Right? And so if the trend line holds, this could be the buying opportunity, not the break above, but the pullback to that line. If it pulls back to that line, that's often a very good buying opportunity. So if I'm looking to get long Aussie, that's how I'm probably going to do it. Okay? Great questions, everyone. 2 great sessions today, and I have a good feeling that there's going to be 2 great sessions tomorrow. So come back and join me then, and I'll be more than happy to speak with you at that time. Until then, my name is Ed Ponsi, your FX educator. Here on behalf of FX Street, I will see you tomorrow. Everybody take care.